Welcome to Mindset in Stone podcasts, where we dive deep into the most compelling books on the shelf. Join hosts Dave and Poppy as they uncover the stories, themes, and ideas that shape our understanding and inspire curiosity. Get ready to explore the big ideas that leave a lasting impact. Let's get started.
Welcome to the Mindset in Stone podcast, where we take the hardest, most complex ideas and dive deep, giving you the clarity and insight you need.
Today, we are taking a deep dive into what many consider the definitive intellectual architecture for long-term wealth creation, the investment philosophy of Warren Buffett, focusing specifically on the core principles detailed in the Warren Buffett Way.
And we are moving far beyond the simple idea of just, buying low and selling high. Our mission here is really foundational. We want to give you a shortcut to understanding the precise intellectual synthesis of everything. Quantitative analysis, qualitative business sense, and that all-important psychological discipline that underpins decades of his unmatched success.
That synthesis is the key word. You aren't just learning a list of stock metrics here. The goal is to learn how to adopt the mindset of a true business owner.
Right.
Because if you can absorb this framework, you gain a rigorous, repeatable lens through which you can evaluate any investment opportunity, and it doesn't matter what your experience level is.
Okay, so let's unpack this intellectual heritage. When we talk about the Buffett Way, it's not something he just invented out of thin air. We're really talking about an integrated methodology built on the genius of three other thinkers: Benjamin Graham, Philip Fisher, and maybe the most transformative one, Charlie Munger.
That intellectual lineage is absolutely vital.
Yeah.
Buffett started as a pure disciple of Graham, the father of value investing. He was focused solely on numerical cheapness.
Just the numbers.
Just the number. But he realized that quantitative cheapness alone often leads you to mediocre or even dying businesses. His real genius came from integrating Fisher's pursuit of quality and Munger's relentless, and I mean relentless, demand for rationality.
So let's anchor this discussion with that quantitative foundation. Benjamin Graham. Graham gave us the critical definition that really separates true investment from dangerous, unplanned speculation.
His core definition is the bedrock of discipline. Graham stated it pretty clearly. An investment operation is one that, upon thorough analysis, promises safety of principal and a satisfactory return.
And if it doesn't meet those two criteria,
So then it is speculation. Full stop. If an operation, after you've done the rigorous study, can't offer both safety for your capital and a predictable, satisfactory return, it's not an investment.
that immediately removes a huge amount of what people do in the market from the investment category. And to get to that thorough analysis, Graham had this three-step process, which was really designed to eliminate emotional decision-making.
Yeah, it's very systematic. First, the descriptive phase. You rigorously gather all the facts about the company, its industry, its history, everything.
In a way.
Second, the critical phase. This is where you examine the fairness and merit of the security relative to all those facts you just gathered. And third, the selective phase, where you pass your final judgment on the security's true attractiveness and whether it really meets those safety and return requirements.
This systematic approach leads directly to Graham's single most famous and, I think, most powerful concept, the margin of safety.
The margin of safety is, it's the deliberate act of building a protective buffer into your decision. You only buy the asset when the market price is significantly below its intrinsic value.
And intrinsic value is tricky. Graham himself said it was an elusive concept.
Exactly. It's a range, not a fixed point, and it's completely distinct from the market price, which can be, all over the place day to day.
What's so brilliant about this is you don't need surgical precision. You don't have to determine the intrinsic value down to the penny. Approximating a reasonable value is good enough if you insist on that wide protective margin.
That cushion is what guards you against your own analytical errors or, unexpected economic shocks. It's your built-in insurance policy.
This quantitative anchor gives us our first practical takeaway for our deep dive today.
Right. So what can you do with this?
Practical takeaway 1. Define your investment. Before you commit a single dollar, subject the opportunity to the Graham test. Ask yourself, does this operation promise safety of principal and a satisfactory return based on thorough analysis?
And you have to be honest with yourself.
Totally. If you hedge that answer, or if you skip the critical analysis part, you're speculating. And you have to either walk away or radically adjust your position size to account for that risk.
So if Graham provided the quantitative floor, Philip Fisher really provided the qualitative ceiling. Fisher was interested in identifying companies with what he called above-average potential and, crucially, management capable of capitalizing on it.
For decades.
For decades, yeah. Fisher believed that just looking at deeply discounted numbers, the way Graham did, often meant you were buying a dying business on the cheap. To find the truly great businesses, you had to look at factors that would never show up on a balance sheet.
And his revolutionary method for this was the scuttlebutt. This isn't just desk research. It's about getting out there and digging into the business grapevine, getting the unvarnished truth.
Yeah, the scuttlebutt involves an exhaustive external investigation. We're talking about interviewing key customers to assess their product loyalty and switching costs. You talk to vendors about the company's payment terms, their reliability.
You even talk to competitors.
Especially competitors. Ask them what they genuinely fear about the company. And sometimes you can even talk to former employees about the corporate culture and the real depth of the management team.
Fisher understood something fundamental. Management often tells you what they want you to hear, but customers and competitors tell you what the company actually is.
And that qualitative depth is essential for identifying a sustainable competitive advantage, or what Buffett and Munger would later call the moat. The moat is what protects a company's high return on capital.
Is it protected by high switching costs, like, proprietary software that's deeply integrated into a customer's business?
Or is it a network effect, where every new user makes the product more valuable to all the existing users? Or is it just a regulatory advantage? The scuttlebutt reveals the real strength and the longevity of that protection.
This intense qualitative research is precisely what led Fisher to his philosophy of focus investing.
Right. If you know a business that deeply, why on earth would you diversify into 50 companies you only know superficially? Fisher preferred owning a few outstanding businesses, often fewer than 10, with maybe 75% or more of the portfolio concentrated in his top 3 or 4 ideas.
Which is pretty radical, even today. And that brings us to our second essential action point.
Yeah, this one is huge.
Practical takeaway 2. Use scuttlebutt research. You have to incorporate qualitative research into your process. When you're considering an investment, seek out information from external, unbiased sources, customers, suppliers, industry analysts, to verify the strength of the company's competitive advantage and the true competence of its management. Go beyond the polished annual report.
Now, we absolutely have to talk about Charlie Munger. While Graham and Fisher provided the tools, you could say Munger provided the operating manual for the human mind. His influence is rooted so deeply in the psychology of misjudgment, and it reinforces the need for relentless rationality.
Munger's great contribution was pushing Buffett past that pure quantitative Graham-style model. I think it was in the 1970s. Munger convinced Buffett that it was far better to buy truly great business at a fair price than a mediocre business at a fantastic price.
And that shift required a huge philosophical leap. Munger introduced Buffett to the lattice work of mental models. He urged him to consider concepts not just from accounting, but from psychology, from history, physics, biology.
A multidisciplinary approach.
Exactly. He believed success came from connecting these disparate models to gain a deeper, more holistic understanding of reality.
And his most famous mental model has to be inversion.
Oh, absolutely. Instead of asking, how do I succeed? Munger tells you to ask, what are all the ways I will absolutely fail? By identifying and then systematically avoiding those failure mechanisms, like using too much leverage or emotional trading success, sort of becomes the default outcome.
Munger really crystallized the idea that emotional lapses by other people create opportunities for the disciplined investor. That famous contrarian statement, being greedy when others are fearful and fearful when others are greedy.
Without Munger's psychological anchoring, the integrated Buffett way, as we know it, it simply would not exist.
Okay, so the ultimate application of this combined thinking, Graham's safety, Fisher's quality, Munger's rationality, it's all filtered through Buffett's 12 tenets. And we're not talking about a simple stock screen here. We're talking about adopting the perspective of a long-term earner buying a fractional interest in a real business.
Exactly. These tenets are grouped into 4 categories: business, management, financial, and market. And if a business fails just one of these fundamental tests, it's out. It's an incredibly strict framework designed to weed out complexity and risk.
Let's start with the first 3 screens, the business tenets. These are all about defining the product and its economic environment.
The first screen is a big one. Is the business simple and understandable? Buffett's philosophy states that investors must truly understand how the business generates cash flow, controls costs, and manages its capital. This preference for simplicity isn't laziness. It's a recognition of the limits of human knowledge.
He famously avoids what he calls difficult business problems. He prefers 1-foot hurdles over 7-footers. I mean, his confidence in the Washington Post in the 1970s came from his deep personal experience with the newspaper business. He understood distribution, advertising.
His understanding wasn't academic, it was operational. And the rule is simple. If you cannot truly explain how the business makes money, you can't value it, and you shouldn't own it.
The second tenet is non-negotiable. Does the business have a consistent operating history? You have to look for a steady, reliable track record that spans different economic cycles. Consistency over decades is a really reliable predictor of future stability.
This means avoiding turnarounds because, as Buffett rightly observes, they seldom turn.
A classic example is Coca-Cola. It has been operating the same core, simple business, selling a branded beverage product since 1886. That stability in its operational history lets an investor forecast future returns with so much more confidence.
And the third tenet is maybe the most critical for long-term compounding. Does the business have favorable long-term prospects? Does it have a franchise? This tenet divides the entire economic universe into great businesses, which he calls franchises, and weak ones, which he calls commodities.
A franchise is defined by 3 characteristics. First, it offers a needed product. Second, it has no close substitute. And third, it's unregulated, which gives it that critical feature, pricing flexibility.
That ability to raise prices just a little bit every year without losing market share is the definitive sign of a strong economic moat.
You contrast that pricing power with a commodity business like, say, textiles or airlines. In commodity businesses, the product is largely indistinguishable from its competitors,
Which forces competition purely on price. And that inevitably crushes profit margins and just destroys capital over the long term.
Buffett says he'll only invest in a commodity business if it can be the absolute low-cost producer and keep that cost advantage wide and sustainable. A company like Geico, for example, achieved this by cutting out the agent distribution cost. That was a structural advantage that others just couldn't replicate quickly.
So once you've screened the business, you move on to the management tenets. This is where we judge the custodians of that franchise. Because even a great business can be destroyed by poor management.
The first question is fundamental. Is management rational?
Right. Managers must behave like true owners, prioritizing increasing the intrinsic value per share. The highest compliment Buffett can pay a manager is when they make rational, transparent decisions about capital allocation.
This means they have to focus on return, not just on size. So many managers pursue growth purely to justify their own status and compensation, even if that growth generates returns that are below the cost of capital.
Which is inherently irrational behavior. It's totally detrimental to the owners, to the shareholders.
Next is transparency. Is management candid with shareholders? Candor demands that they report data honestly. To help shareholders answer 3 crucial questions. What is the company really worth? What's the likelihood it can meet its future obligations? And, simply, how good a job are the managers doing?
And this requires reporting that goes way beyond standard accounting rules. We have GAAP, which is generally accepted accounting principles, and non-GAAP, which is often adjusted earnings. But Buffett places immense value on what he calls extra GAAP disclosures.
Extra GAAP reporting is the narrative context. It's the qualitative, forward-looking commentary where management discusses known risks, outlines their capital allocation philosophy, and, this is crucial, they admit their mistakes.
Buffett himself is the gold standard for this. He famously lists his mistake du jour in his annual reports. That provides essential context that the numbers by themselves simply cannot convey.
The third management tenet is where the behavioral master, Munger, really shines through. Does management resist the institutional imperative? This is that unseen, powerful force that drives so much corporate hyperactivity.
The institutional imperative causes corporate leaders to imitate their peers, to resist structural change, and, most damaging of all, to expand recklessly just to soak up available funds, even when the returns are subpar. It's the drive for corporate empire building over shareholder value creation.
You see this all the time when managers try to buy growth at any price. Think about the infamous acquisition of Dexter Shoe by Berkshire Hathaway. Buffett himself admits he succumbed to this pressure in 1993, buying a poor business at an exorbitant price.
It turned into one of his largest mistakes. And that failure just proves how powerful the impulse to follow the herd can be, even for the most rational investor in the world.
This deep analysis of how management uses cash leads us to our next 2 critical takeaways.
Okay, so this is about judging the people in charge.
Exactly. Practical takeaway 3. Judge managers by cash allocation. Scrutinize what management does with its excess cash. If that cash cannot be reinvested inside the company to produce an above-average return on equity, a return higher than the cost of capital, then the only rational choice is to return that money to the shareholders.
Either through sustained dividends or preferably through well-timed share buybacks when the stock is cheap.
And tying directly to the dangers of that institutional imperative.
This is a psychological one for you, the investor.
Practical takeaway 4. Resist mindless imitation. You have to actively identify when you are following the crowd simply out of a fear of looking foolish. Be willing to succeed unconventionally, even if it risks the short-term discomfort of failing conventionally. The biggest mistakes often happen when you engage in hyperactivity just because everyone else is.
Okay, so with the business and management foundations laid, the financial tenets are the core metrics Buffett uses to verify that the economic claims of the franchise are actually, working over time.
Number 1, focus on return on equity, ROE, and make sure it's achieved with little or no debt. Buffett looks for a high ROE, preferably around 20% or more, because it demonstrates how efficiently a company uses the capital shareholders have entrusted to it.
Now, ROE is easily manipulated with debt, so that's the key. Finding a company that achieves, say, 25% ROE with minimal leverage like Coca-Cola hitting 31% by 1988, that is the ultimate sign of a phenomenal franchise business. It's self-funding and highly profitable.
However, relying purely on reported earnings per share can be dangerous. This brings us to the crucial metric he developed for valuation. Calculate owner earnings.
This is a vital technical point, but it's not that complicated. Owner earnings is the true cash generation capability of a business. It's the cash that the owner can actually withdraw at the end of the year without damaging the business's competitive standing.
So what's the formula? How do you figure it out?
The formula is pretty straightforward, but it's critical. You take net income, you add back depreciation and amortization, since those are non-cash expenses, and then you subtract the capital expenditures required just to maintain the business's competitive position.
Okay, third financial tenet. Look for companies with high profit margins. This is a clear indicator of a strong moat and good cost control. High margins separate the franchises that can price effectively from the commodities that are stuck pricing at cost.
A great example is IBM's strategic shift in the 1990s. When they pivoted away from low-margin hardware toward higher-margin consulting and software services, their net profit margins nearly doubled to over 15%. That reflects a conscious strategic decision to seek out activities with greater pricing power.
The final financial tenet is the ultimate test of rational capital allocation, the $1 premise.
For every single dollar retained by the company, meaning not paid out as a dividend, that dollar must create at least $1 of market value for shareholders over time.
So if a manager retains earnings, but only generates 50 cents of future market value from that dollar,
They should have paid the dollar out in the first place. It's that simple. The Washington Post in the 70s and 80s was a prime example. The company created $1.81 of market value for every $1 it retained. That ratio is basically the shareholder's report card on management's overall competence.
So these robust financial tenets set the stage for the market tenets, which address valuation. If we have a great business, managed rationally, and it's verified by strong financials, the final step is timing and pricing.
The first market tenet is determine the value. Buffett sticks to the classic definition here. The value of a business is the discounted present value of its expected future net cash flow, or what we now call owner earnings, over the entire life of the business.
And what about the discount rate? That's always a point of contention.
For the discount rate, Buffett often just uses the long-term risk-free rate, like the 30-year U.S. Treasury yield. His argument is that using the risk-free rate is appropriate because if you can't beat that rate by buying a great business, you might as well just buy the Treasury bond and do nothing.
And the non-negotiable final step, which comes straight from Graham.
Buy at a significant discount to value. This is the final, decisive application of the margin of safety. The price you pay must offer a substantial discount to your calculated intrinsic value.
This emphasizes our fifth major takeaway, tying that quantitative safety right back into the qualitative research.
It really brings it all full circle.
Practical takeaway 5. Demand a margin of safety. Calculate the intrinsic value of a business using owner earnings and the risk-free rate. But because all estimates are imperfect, you only execute the purchase when the market price offers a substantial discount.
And that can be anywhere from, say, 15% to 55%, depending on how predictable the business is. That significant discount is your essential insurance policy against your own estimation errors.
Now, all of these rigorous rules, they rely entirely on the investor's ability to be perfectly rational. And that brings us to the single greatest obstacle in investing, the psychological hurdle known as dysrationalia.
Dysrationalia. It was a term coined by the psychologist Keith Stanovich. It's the inability to think and behave rationally despite having a high IQ. Buffett often points out that a high IQ is not enough. If it were, the world would be ruled by academics, not entrepreneurs.
This cognitive failure often comes from a processing problem. It's about relying on quick, low-effort System 1 thinking, which is automatic and emotional, instead of engaging the deliberate, rule-governed System 2 thinking, which requires effort, time, and intellectual self-control.
System 1 thinking is what happens when investors rely solely on simple, common metrics PE ratios, price-to-book ratios, or quick technical charts. These are ideas that are straightforward and obvious, and they're instantly discounted by the market. They offer zero analytical edge.
Buffett's tenets, on the other hand, are what you'd call slow-moving ideas. They aren't conceptually difficult, but they require the laborious effort of System 2.
Things like reading hundreds of pages of annual reports, studying competitors, understanding long-term demographic and business trends. That effort is what most market participants avoid, and that's what creates predictable, long-term investment opportunities.
The entire market runs on psychological biases that are rooted in System 1 thinking. Things like the availability heuristic, where people overemphasize the latest news, or confirmation bias, where they only seek information that confirms their existing belief.
And that deep, slow System 2 analysis is the antidote to all of those biases. This insight gives us our sixth practical instruction on how to engage that deep processing power.
Practical takeaway 6. Engage System 2 thinking. You have to resist the temptation to rely on easily accessed, quickly discounted metrics like PE ratios or technical charts. Force yourself to engage System 2 by committing to read the annual reports of a company and those of its key competitors. Study the industry trends to grasp the complex long-term dynamics.
The market inefficiency is always created by the slow, hard work that other people refuse to do.
Okay, so once you've completed that deep System 2 analysis, the final step in the Buffett way is execution. And this really rests on two pillars: focus, investing, and extraordinary patience.
Right. Conventional academic portfolio theory preaches broad diversification. It argues it's a necessary defense against uncertainty. And, if you don't know what you're doing, owning 50 or 100 things protects you from making one huge individual mistake.
But it also guarantees you only get mediocre market-matching returns.
Exactly. Buffett famously counters this, saying, diversification serves as a protection against ignorance. But for the know-something investor, the one who has diligently applied the scuttlebutt, the 12 tenets, and the margin of safety concentration actually decreases risk.
How does that work?
Because it forces a greater intensity of research and higher confidence in the select few businesses you own.
So focus investing is defined by concentrating your capital in, say, 5 to 10 companies you understand best, the ones with the highest probability of above-average performance. Berkshire Hathaway often has over 75% of its entire portfolio in just 5 securities.
That level of conviction is only possible because the research behind each one of those picks is absolutely exhaustive.
Now, this concentrated approach inherently brings a higher level of price volatility. And this is where Buffett's definition of risk radically diverges from what's taught in academia.
It's a huge difference. Modern portfolio theory defines risk as price volatility, or standard deviation, basically, the jitteriness of the stock price. But Buffett defines risk as the possibility of permanent harm or injury.
The loss of your purchasing power or the chance that the underlying business fundamentally deteriorates.
Therefore, price volatility is not risk, it's an opportunity. For the rational investor who knows the intrinsic value of a business, volatility represents the market's irrational mood swings. It's Mr. Market offering to sell you great assets on the cheap.
Buffett and Munger are masters at being bump ignorers.
That psychological resilience is essential because a focused portfolio will have a bumpier ride. If you've done your homework, you have to learn to ignore the market noise and focus entirely on the underlying economic performance of the businesses you own.
And that patience, that inactivity, is what generates that exponential compounding over time. Buffett's preference is to hold stocks forever. Inactivity is intelligent behavior because high turnover costs you immensely in 2 ways: trading costs and, even more importantly, accelerated capital gains taxes that just eat into your compounding returns.
Low turnover is a financial superpower. There are studies that show investment funds with low turnover, defined as 0 to 20% annually, consistently outperform high turnover funds. They just let the power of compounding work, and they avoid the behavioral trap of myopic loss aversion that drives all that frantic short-term trading.
The evidence is just overwhelming. You have to be positioned for the long haul. A significant percentage of S&P 500 stocks double over rolling 5-year periods. The massive returns are there, but only if you have the patience to sit through the inevitable bumps in the road.
This brings us to our final critical instruction for adopting this business owner mindset and successfully managing a focused portfolio.
Practical takeaway 7. Commit to the long term, 510 years. When you acquire a fractional interest in a business, you have to commit to a minimum holding period of 5 years. 10 years is vastly preferable. Your initial analysis has to justify that holding period.
And there's one mandatory rule that goes with this.
Never leverage your focused portfolio. Margin calls based on temporary price volatility can instantly wipe out a well-tuned portfolio. It forces you to liquidate your best assets at the exact moment prices are temporarily depressed. Rationality demands avoiding leverage when you're executing the long-term Buffett way.
So, to summarize the key insights we've uncovered today, the Warren Buffett Way is a rigorous, integrated system. It combines Graham's insistence on a quantifiable margin of safety, Fisher's qualitative depth in finding great franchises, and Munger's unwavering rationality to allocate capital efficiently.
And success really hinges on understanding that you are an owner, not a speculator. And that demands rigorous System 2 analysis and the patience to ignore the market's manic depressive mood swings. His enduring success rests on finding subsidiaries that generate substantial cash and then rationally allocating that capital into the next great opportunity.
So we'll leave you with this final provocative thought. It's a challenge designed to force you to engage that deep System 2 processing power right now.
If your entire retirement depended on the successful growth of a single company's stock over the next 10 years, which business would you pick and why?
Force yourself to answer that question using only the business, management, and financial tenets we detailed today. That deep, comprehensive analysis, stripped of all market noise and emotion, is the true core of the Warren Buffett way. Now go put that discipline to work.
We hope you're leaving with fresh insights and a spark of inspiration. Remember to subscribe, leave a review, and check back for more episodes as we dive into new worlds of thought, one book at a time. Until then, keep your mind set in stone and your curiosity open. This has been a Big L Riz Media podcast, where big ideas meet lasting impressions.